Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money secrets hiding in plain sight. And let me tell you, this next report is about a fund that is trying to make some serious credit moves. Grab your popcorn because we're diving into Fidelity Private Credit Fund's latest update. This isn't just another dry corporate document. Folks, this is a peek behind the curtain at how this fund is navigating the world of private credit. And trust me, credit is king, especially when interest rates are doing their dance. Alright, let's get straight to it. The document we're unboxing today is from Fidelity Private Credit Fund, and it is a pretty standard update. Think of it as a quick check-in on how things are going. It is dated the 4th of February 2026, giving us a snapshot of their situation as of the end of 2025. Now, Fidelity is a big name in the financial world, and private credit is a really interesting area. It is essentially lending money to companies that aren't publicly traded, and it can be a huge source of capital for businesses. This means they're reporting to the US Securities and Exchange Commission, or the SEC, which is like the referee of the stock market, making sure everyone plays by the rules. This is a requirement for publicly reporting companies, and it is all about transparency. Now, this is interesting. The filing indicates that Fidelity Private Credit Fund is considered an emerging growth company. What does that mean? It basically means they're a newer company, or at least they qualify as one, and they get to follow some slightly different, often less demanding rules when it comes to reporting. It is like the SEC giving a bit of a break to newer businesses to help them get off the ground without drowning in paperwork. This is where the main event is. The fund put out a fact sheet as of December 2025. Think of this fact sheet as a summary of their performance and holdings. It is the juicy bit that tells us what is really going on, and importantly, it is included as an exhibit, which means we can actually look at it. So on the 4th of February of 2026, they released this fact sheet covering the state of things right at the end of the previous year. This isn't a deep dive into every single transaction, but it is a high-level look at their portfolio. It gives investors and interested parties a clear picture of the fund's size, its investments, and its overall health at that specific point in time. This exhibit is the key here. It is the actual fact sheet. Since the filing itself doesn't contain specific financial tables or detailed results, this fact sheet is the source of that information. What we're looking for in this fact sheet are the numbers that matter most. How much money are they managing? What kind of returns are they seeing, and what are the risks involved in their private credit investments? Now, a fact sheet from a private credit fund won't look like a typical earnings report from a company like Apple or Google. You won't see charts of revenue or profit in the same way. Instead, you'll see things like assets under management, the types of companies they've lent to, maybe some information about the debt instruments themselves, and any key performance indicators. When we talk about private credit, it is important to understand that it is a bit more opaque than publicly traded stocks. The companies that borrow from these funds are often not as transparent. This means the risks can be higher, but the potential rewards can also be more attractive. It is a trade-off. Fidelity, being a large institution, likely has strong due diligence processes in place to mitigate some of these inherent risks. Looking at a fact sheet as of December 2025 for a private credit fund, we'd be keen to see how their portfolio is diversified. Are they heavily invested in one industry or spread out? What is the average maturity of their loans? Are they focused on senior debt, which is less risky, or are they venturing into more subordinate debt, which offers higher yields but comes with more risk? The December 2025 date is particularly relevant given the economic climate of recent years. Interest rate changes, inflation, and recession fears all play a significant role in the private credit market. A fund's performance around this time would reflect how well it has navigated these choppy waters. If this fact sheet were to show a significant increase in assets under management, that would signal strong investor confidence. Conversely, a decline might suggest investors are pulling back, perhaps due to concerns about the broader economic outlook or the fund's specific performance. We also want to know about credit quality. Are the companies they're lending to financially sound? Are there any signs of distress, like companies struggling to make interest payments? While a fact sheet might not detail every single loan, it might give broader indicators of the portfolio's health. Are there provisions for loan losses? What is the outlook for defaults? The nature of private credit means that liquidity can be an issue. Unlike public markets where you can sell shares quickly, selling private debt can take time and might involve discounts. So, how is Fidelity managing this? Are they providing clear timelines for investors to access their capital, or is it locked up for extended periods? Ultimately, this fact sheet is all about assessing the performance and risk profile of Fidelity Private Credit Fund. It is a snapshot that helps investors decide if this is the right place to park their money. Given the current economic environment, stability and predictable returns are big draws, but so is the potential for higher yields that private credit can offer. The key is understanding the balance Fidelity is striking between risk and reward. Now let's wrap this up with my take. Fidelity Private Credit Fund is operating in a space that is both lucrative and risky. The fact that they're identifying as an emerging growth company suggests they're still building their footprint or perhaps have a specific structure that qualifies them for this status. The real story, though, lies within that December 2025 fact sheet. Without seeing the specific numbers from that exhibit, it is hard to give a definitive judgment, but generally, for any private credit fund, strength lies in diversification, robust underwriting, and clear communication about risks and liquidity. Opportunities exist in underserved markets or specialized lending, while risks are tied to economic downturns, interest rate volatility, and the inherent illiquidity of private loans. Alright, that is our quick dive into the Fidelity Private Credit Fund's reporting. What is your take on the world of private credit? Do you think funds like this offer attractive opportunities, or are the risks too high right now? Drop your thoughts in the comments below. If this analysis was helpful in shedding some light on these documents, please hit that like button and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for even more discussions and exclusive content. Thanks for watching, and I'll see you in the next one.